Welcome to Phillip Futures Weekly Market Watch. I'm Han Qiang, Technical Analyst from the Phillip Futures Research Team. I will be discussing the India rupee today. Let's start by taking a look at India GDP year-on-year percentage change. You can see from the chart that India GDP growth slowed sharply since early 2011. The economy expanded 5.3% in the first quarter of 2012. This is a sharp drop from 9.2% expansion in the same period last year. Current elevated inflationary pressure combined with weak real economic activity have triggered stagflation fear among investors, causing investment to fly away from the country. This has caused the rupee to weaken. This is a chart showing India industrial production year-on-year percentage change. The latest reading in April for industrial production rose less than what was estimated. The consensus among economists was for industrial production to have a year-on-year percentage climb of about 1.7%. The actual gain only turned out to be 0.1%. This chart shows India Wholesale Price Index year-on-year percentage change. India inflation accelerated in May to 7.55% as price increased for food and fuel. This uptick in inflationary pressure adds dilemma to the India Central Bank that is trying to keep inflation under control while economic growth weakened significantly. Failure to control the elevated inflation has caused investment to move out of the country. This has weakened the rupee, further adding to inflationary pressures, potentially causing a vicious cycle. This final chart shows India current account in billions of US dollars. India reported a current account deficit equivalent to 19.4 billions in the fourth quarter of 2011. This current account deficit was almost double the amount a year earlier. The sharp deterioration in current account was attributed to slowdown in exports, even as import of fuel grew at a rapid pace. India stands opposed to the rest of Asia with a large current account deficit, while the rest of the region have surpluses. This large current account deficit becomes a currency issue when it cannot be comfortably financed due to global tightening of US dollar liquidity and an attitude of risk aversion. In conclusion, in terms of monetary policy, India is crippled. The India Central Bank is caught between declining economic activities and high inflation. In terms of fiscal policy, it is difficult for the government to implement a stimulus package due to its high debt. Possible downgrade to junk status will increase borrowing costs. An Indian government that is unresponsive due to political struggle aggravates the problem because economic reforms and infrastructure investments are impeded. The government needs to get their act together, be more coordinated and focus on their policy formulation. Before that happens, it is difficult for us to view India positively. With this, I end my presentation. Thank you and tune in to the next Phillip Futures Weekly Market Watch.